Hello, everyone. Good afternoon, and welcome to the latest installment of our Frontier View webinar series. Today, we'll be examining the outlook for Sub-Saharan Africa and specifically what business executives should expect from the region in light of COVID-19 and how they should go about planning for next year. I'm Zeynep Köseri Solo, Director for Turkey and Middle East Africa Research, and I'm joined by my colleagues William Atwell, who is our head of Sub-Saharan Africa research, and Matthew Kindinger, senior analyst for SSA. Will has over 10 years experience researching African economies as an analyst and government advisor, and Matthew previously worked on the downstream oil and gas sector and is our in-house West Africa specialist. So we will be sharing with you our outlook on the region in the next hour ahead. And in the meantime, please keep in mind that if you have any questions, any technical difficulties, or questions about the content that we are sharing, do reach out to DuckerFrontier webinars that you see on the right side of the panel. And I'll turn it over to the Sub-Saharan Africa team to get us started.
Thanks, Zeynep, and welcome everyone to the webinar today. Very much looking forward to having a good discussion. We do have a question option here, and so if you do have questions throughout the session, please do go to the question box and select DuckerFrontier webinars, and you can write your question in there. It'll be private as long as you select DuckerFrontier webinars, and then we have a Q&A section at the end where one of my colleagues will read out a selection of the questions, and we'll certainly be able to go into a little bit more detail. So kicking things off, we're going to be looking at the drivers for the SSA outlook over the next year to 2 years, looking at how SSA is being affected by COVID-19, but of course there are many other developments going on in the region too, which are shaping the macroeconomic outlook too, and how businesses should really incorporate this into their planning for the next 12 to 24 months. We're also going to be leaving some time for a bit more of a round the region, doing some market deep dives on really key markets. I know Nigeria, South Africa, of course, responsible for the bulk of businesses' sales and revenue in SSA, but also some of the other high interest markets too, that certainly still offer opportunities going into 2021 and beyond. So with that, I'm going to really dive right into the content for today. There are really three, I suppose, main business takeaways that we would advise clients and anyone in the audience to incorporate into how they're thinking about the SSA region, looking ahead to the next 6 months and into 2021 and beyond. So the one is, of course, there is a very serious shock to SSA markets. This is unprecedented. Only really in the 1970s have we seen such a sharp downturn in the SSA region. So it's really important to take some immediate steps to preserve cash flow, of course, to preserve the stability of your own business, but also looking ahead to business continuity into the next year. Of course, priority distribution partners, priority customers, probably going to need some assistance too. So, of course, planning for the future while building some of that continuity into your business plans. And then, of course, the opportunity environment has shifted around many of the assumptions that companies typically have based their plans on for 2021 and beyond. We know the growth outlooks for markets have changed quite dramatically, a number of them in quite serious recessions this year and struggling into the future as well. So important to rethink perhaps where investments are placed to make sure that there is a meaningful return on those investments. And then, of course, this is an extremely uncertain and volatile future that we're going into. So really important to use scenarios when planning as well. And we'll go into a little bit more detail, particularly on the big markets, about what those scenarios look like and what potential downsides and in a less likely situation, upsides would look like as well. So those are really the kind of big three themes, and you'll see they weave through everything that we're going to talk about in the next 50 minutes or so. So in terms of what is ultimately driving the SSA outlook, there are four main issues here. The one is the global environment and how it's impacting SSA markets. The other is, of course, the response that SSA governments, African governments, have themselves taken in response to COVID-19. The virus itself, of course, very difficult to exactly model the economic impact, but what really is directly impacting these economies are the measures that governments are taking, the lockdowns, which have really cut down economic activity, and some of the support measures that governments are putting in place where those exist. And then finally, SSA markets are in general fairly vulnerable to exogenous shocks. Many of them are dependent on single commodities, for instance, or there's very high poverty levels. Those kinds of things certainly make economies more vulnerable to these kinds of shocks, and we'll be exploring how some of these vulnerabilities map out into the economic outlook as we go forward. So in terms of how we understand the virus at DuckerFrontier and how we expect it to unfold in the coming months, we don't expect it to go away. This isn't a first half of 2020 problem. It's going to be with us for some time, and we certainly don't expect any kind of mass distribution and effective implementation of a vaccine, before late 2021. As well, we expect some form of social distancing to continue, policies applied and withdrawn again in a very uneven and haphazard way. So this is going to be with us for some time yet. So even more important, of course, to use things like scenarios and, of course, increase monitoring of markets to make sure that we are ahead of the curve in terms of understanding how these measures are going to affect us. So in terms of how all of these things boil down to, what do they boil down to? Essentially, slow drawn out recoveries, of course, fallout, in many cases, the impact of debt affecting markets for some time to come. And of course, we're going to see political and social ripple effects continue into 2021. And SSA certainly no stranger to political and social volatility. So we'll explore some of those things as well. So in terms of the global environment, of course, SSA integrated with the rest of the world, many of its important trading partners in the EU, China, a really important trading partner as well, and market for African commodities, whether it's copper or oil or other metals, have all had a very severe shock through 2020. And the bad news, I suppose, is we don't expect a significant bounce back in the second half of the year. Some stabilization, of course, but not a bounce back by any means. So, very deep recessions across many of these markets, and that's affecting demand, of course, for products that SSA markets export, whether it's those commodities, but also in some cases manufactured goods, food, horticultural products, also affected by the slowdown and the continued weakness through much of 2020. One of the other effects that the big global slowdown has been to extend and exacerbate the weak oil price environment and weak commodity price environment generally. So whether it's markets like Angola and Nigeria, which are of course very dependent on oil for their export earnings, for their foreign exchange reserves, but also mining dependent markets like Zambia too, really exposed to the weak copper demand environment. So this is an environment, of course, that's going to persist through this year. And we can expect some recovery going into 2021, some stabilization, but of course, by no means a return to the high commodity price environment that we saw in the 2000s and to some extent in the early 2010s. So boom times, I'm afraid, not coming back in the medium term by any means. Now, the other side of it, we've talked about the global environment and how it's affecting SSA. The flip side of it, of course, is the regional environment and how that's affected economic activity in the region. So SSA was, of course, affected by COVID-19 a little bit later than many other regions. Only really in March do we start to begin to see some cases really picking up a bit more in April, May, and of course now quite serious accelerations in places like South Africa. And we haven't seen an even response across the continent's 48, 49 governments. Some were pretty slow to respond to begin with. Some, like South Africa, Rwanda, for instance, implemented very strict lockdowns right away. and that was probably necessary to contain the spread of the virus, but of course it also had very serious economic consequences. So real shutdown of business activity, which was really reached a height in April, particularly in South Africa, but in other regions too. And now going into the middle of the year and of course into H2 now, we're seeing a bit more lifting of restrictions. Kenya extended its curfew further but reduced the hours. South Africa is going into a slightly lighter version of the lockdown at the moment. And some of these other markets as well never really implemented very, very strict lockdowns to begin with. So Tanzania, for instance, has never implemented very strict lockdowns. Zambia, similarly, relatively mild lockdowns, and now it's lifted some of those as well. But of course, as we go into the rest of the year, we would expect more measures to be lifted, curfews or restrictions on border crossings, restrictions on people's ability to conduct normal day-to-day business activity, whether it's outdoor markets or other forms of retail, things like that, ability to access their farms. And we'd expect that to continue, but of course in this patchwork, haphazard way. And that applies from one national government to another, but also within individual markets. We'd expect some of these lockdown measures to be interpreted slightly differently by local officials, and there'll be variations across different states and provinces as well. And I think Nigeria is quite a good example of this as well. Perhaps, Matt, you could provide a little bit of context around the different levels of lockdown that we might see going forward.
No, that's right. So Nigeria is a really interesting case in terms of how the government has approached COVID-19 lockdown restrictions. Nigeria was one of those countries that never had a national lockdown, but there were two layers of lockdowns. The federal government introduced a series of lockdowns in Abuja and Lagos and Ogun State. And these are in the process of being lifted, and the federal government has communicated this quite clearly and quite well. But there have been a number of surges in cases in regions or states of Nigeria. And as a response, state governments have introduced lockdowns at very short notice. And this is likely to continue with lockdowns being introduced at a local level with very little notice and also being removed quite quickly as well. So quite difficult to track and predict in Nigeria.
Great. I suppose makes sense to look at now how governments are responding from a stimulus perspective. We looked at the lockdowns, which have been aimed at trying to contain the virus. Governments have also, and other authorities have also been concerned about the economic impact. So I suppose on the one hand, we've seen a number of governments and central banks moving to loosen monetary conditions. So numerous credit interest rate cuts in South Africa, even interest rate cuts in markets where we haven't seen interest rate cuts for some time. Zambia, for instance, where inflation is very high. And this is, of course, all in an attempt to try and provide some cushioning to businesses and households, provide some stimulus to the economy. However, in a lot of these markets, this is unlikely to have a very significant economic impact. In some, credit access remains very challenging, despite what we hear about the growth of mobile money and other innovations like that. Credit access remains fairly difficult. Interest rate cuts are not necessarily going to provide a big boost, and we certainly wouldn't see a kind of credit-driven increase in demand, for instance. But this is certainly helping to provide a bit of cushion and might prevent some of these recessions that we're seeing from deepening even further. So this is certainly a reality we're looking at right now. The other side of it, the coin, of course, is fiscal stimulus, and governments across the region have taken several steps to try and support their economies through additional spending mechanisms. South Africa is probably the most extensive, and one could say expensive as well, in the sense that it's package is around 10% of GDP, about 500 billion or so, and that is certainly providing a range of supports to businesses, to households, additional supports for families, for instance, soft loans for businesses, extended tax deadlines, things like that. We're seeing a number of other markets do similar things. But of course, those markets that are very fiscally squeezed, Angola kind of stands out here, really not in a position to provide much in the way of additional stimulus measures, really because the fiscal resources really aren't there due to the hit from the commodity price downturn. So really difficult for markets like Angola, to some extent Zambia, although Zambia's recently announced a package around $400 million or so of various kinds of supports. Of course, this comes on the back of really difficult fiscal environment. We know that SSA markets have been building up quite significant debt piles for some time, particularly over the last 5 years. So already very heavily indebted, quite difficult to really borrow more, and more of their revenue, which has of course taken a hit due to lower tax takes, for instance, more and more of their revenue going on debt servicing costs. Contributing, of course, to those debt servicing costs are a series of credit rating downgrades in several markets, prominently South Africa and Nigeria as well, of course, making the cost of borrowing more expensive. One of the big initiatives we've seen at a global level has been various kinds of debt relief support to the G20 countries, for instance, providing some holidays in terms of debt repayments. IMF also providing a bit of a leeway in terms of the poorest markets globally, most of them being, of course, in SSA. And China came out recently and said that they're providing some debt relief. But this is, of course, all a band-aid on a much larger problem, and it only really lasts through 2020. 2021, the debt problems are still going to be there, and certainly going to affect government's ability to spend and invest going forward. So really changing the outlook quite considerably given this fiscal hit that coronavirus has caused. So I mentioned some of the debt and additional funding that's coming from big organizations. A lot of this really going into public healthcare and COVID-19 containment schemes rather than general budgetary expenditure. So we, in many cases, expecting a bit of a slowdown in terms of government spending. So what does all of this mean in terms of the outlook, which we'll move on to now? Really these kind of 5 big themes. So weaker demand, in some cases contracting demand, but slower growth in most cases across SSA. Much more cautious spending behavior from customers across the region. Quite an erratic regulatory environment, as we've seen with those uneven moves to impose or reduce COVID-19 containment measures. Of course, increased financial pressures due to the debt environment, but also, of course, cash flow issues that businesses are going to be facing due to their lack of sales due to through the lockdowns, and then a very uneven recovery, which is what we're going to turn to now, and really look at, I suppose, as companies and investors plan for 2021, what kinds of numbers should they be putting into their plans? Which markets are they likely to be able to gain additional revenues from and ensure some kind of return on their investments. So in terms of the growth outlook, this is our current view. Of course, I think like a lot of analysts, we've been constantly pressure testing and revising our forecast as we learn more about how these markets are coping or not coping with the COVID-19 hit. You'll see a very deep recession in South Africa, but also Angola, Zambia, Nigeria, Cameroon in recession too. I suppose my one qualification here would be to not read too much into the positive growth numbers, particularly for those markets like Nigeria, Zambia, where they're quite low to begin with. Of course, there is a very strong base effect as a result of these deep recessions in 2020. So, growth of 1.5% to 2.5% in 2021 in this context doesn't really represent a big bounce back in terms of demand. It just means that we're not expecting an even deeper slowdown in economic activity. So, data is one thing, but out there in the real world, we'd expect demand to still be pretty flat actually in 2021 in many of these markets. And this is due to those structural vulnerabilities that I mentioned earlier. Jobs lost during COVID-19 don't necessarily spring back in 2021. Government budgets remain under pressure, particularly as they're hit with debt servicing costs, which they're going to have to resume in 2021 after the debt relief programs fall away. And there's going to be lasting structural damage in a number of these economies too. Matt, I'd like to draw you in here again, perhaps just point out one or two, I suppose, of the bright spots in the region. I know Francophone West Africa, perhaps a little bit more resilient looking ahead.
Yes, that's right. So some of the Francophone markets in West Africa, such as Cote d'Ivoire and Senegal, are not expected to fall into recession this year. And they do have quite bright outlooks for 2021 in terms of their recoveries. And this is for a number of reasons. One is that the growth drivers are quite diverse. These countries have relatively diverse export bases, and we are expecting to see a bit of a bounce back next year in terms of export demand, especially for oil, but more related to commodities such as cocoa and other agricultural products. These countries have also gone through a number of years of pro-business reform in attracting foreign direct investment and making the domestic business environment more conducive for commercial activity. So they're quite well positioned to recover from weak growth this year, next year.
Great, thanks very much. Of course, when we're thinking about return on investment, where companies or investors should be placing their resources to get a return next year, growth metrics are, of course, important, but also important to think about the size and sophistication of these markets, what that bucket of customers looks like, whether it's B2B customers or the sort of rising middle class, for instance. Where are those customers? How much do they spend? What is the scale of the opportunity? An important factor as well. And then, of course, the business fit, the risk environment. How scalable is business in those different market environments? An important consideration as well when thinking about return on investment. So we find it quite useful to look at these in terms of scale as well as growth. So when we're talking about the quote unquote middle class, which I know there's a lot of misunderstanding around spending powers and so on. So we're just using, I suppose, a more premium segment here to talk about the middle class. But really, there are markets that are too big to ignore. South Africa, of course, stands apart as a significantly wealthier, more sophisticated market, which companies can't really compensate for by growing their investments in other parts of the region. And this holds true into 2021 as well. Of course, Nigeria, a very large consumer market, but a much smaller proportion of the population falling into that consumer sort of wealthier consumer bracket. Number of other markets offering opportunities though. Kenya, fairly sizable and fairly wealthy. Ghana as well, fairly sophisticated environment going into 2021 and in a relatively better position to recover as well. When it comes to government spending, public procurement over the past several years has been a big source of opportunity for multinationals as governments build out their public services, invest in infrastructure. All of those kinds of things have been part of the Africa Rising quote unquote story over the past decade or so. And there have been a number of markets where we've seen government spending growth, into the double digits. Ethiopia, Cote d'Ivoire previously. Of course, many of these markets have now had to issue, particularly in the last few weeks, revised budget assumptions, and some are actually having to cut their budgets, their recurrent spending, by quite considerable degrees. We do still expect healthcare spending to remain a priority, of course, given the current crisis, but general areas of budget expenditure probably seeing some significant cuts, particularly in places that are hit by the commodity price downturn. DRC Congo, Nigeria, Angola prominently, Cameroon reduced budget expectations as well. Things not going to change too much for markets where there is quite considerable fiscal pressure as a result of those debt buildups, for instance. Ghana actually likely to pursue further fiscal consolidation next year. Zimbabwe, of course, has had an ongoing crisis for some time, and we don't expect that to change too much either. A number of other markets that are perhaps in a slightly stronger position, where we expect the economic uptick to happen sooner, a bit more resilient. Some of those East African markets, the Francophone West African markets, we'd perhaps see a bit more of a return to opportunity in 2021 for companies selling into the public sector. And then I suppose finally, just to round out the outlook for the region, before we delve into some of those sub-regional deep dives, important for companies to think about what the incentives are for governments going forward in terms of what they want their economies to look like post-COVID. We know that COVID has exposed a lot of vulnerabilities in terms of their reliance perhaps in one industry or another, or their exposure to actually quite fragile global supply chains, as they've noticed shortages of certain products, things like that. So a big theme we expect going forward is going to be on localization, governments seeking to attract investment into manufacturing industries, for instance, to try and resuscitate some of those jobs. That's going to be a key theme. But of course, this comes with some risk as well, particularly for companies that have been importing products into the region for some time, perhaps a bit more in the way of import bans, import restrictions, restrictions on access to foreign exchange. This has been a big issue in Nigeria, which I know Matt will touch on in a little bit, but we've seen it in other markets too, Cameroon, for instance. Going forward, we'd certainly expect continued offerings in the way of tax and other incentives for companies looking at investing in industry in parts of East Africa, for instance, as well. Great. So I suppose, just finally, what does this mean as we look ahead to 2021 across different industries? Very varied picture when it comes to the recovery. We certainly don't expect the tourism and hospitality sector to recover to pre-COVID levels anytime soon. We've seen that with the major slowdown in the global aviation sector, but perhaps on the back of some of those incentives that I mentioned earlier, manufacturing could start to pick up during the course of 2021, and of course other areas like retail, consumer spending driven industries perhaps picking up as well in sort of mid 2021 too. Great. So I know that we need to move on to our deep dive discussions. The one area I suppose I'd point out, though, offering continued risk going into the rest of this year and into 2021 is on the political risk side, with significant increases in the poverty rate. Many of those previously middle class households in SSA actually falling back into poverty, and of course a rise in authoritarianism in many markets where we've seen governments take advantage of COVID-19 to become more authoritarian, stamp out opposition, that sort of thing. We'd certainly expect heightened political risks both this year and into 2021. We have quite a packed election schedule with many governments going to the polls in 2021, and this could provide some flashpoints. And I'd certainly keep an eye on markets like Ethiopia next year, when we will probably have the delayed election. Later this year, of course, we have the Cote d'Ivoire election as well, and that could be quite disruptive too. So important to build these risks into planning ahead. Great. So Matt, let me hand over to you to talk us through the Nigeria outlook in a bit more detail, and if we have time as well, touch on some of the West Africa key West African markets too.
Fantastic. Thanks very much, Will. Great. So we're just going to start by taking a look at the impact of the pandemic on the business environment in Nigeria. And you can see that businesses are already feeling the impact of the pandemic and the economic slowdown. The chart to the left shows business confidence by sector. This is data that is collated by the Central Bank in Nigeria. And what the data shows is a contraction in a negative number represents contraction in the outlook and activity, and a positive number represents an improvement in activity and the outlook. And what we've seen is a contraction across all sectors. So this is quite significant in that no sector has been untouched by the slowdown in Nigeria. And this really reflects the effects of the lockdowns in the major urban hubs, the domestic transport restrictions as a result of interstate travel bans, weaker access to foreign currency in recent months as a result of the oil price crash, and also higher inflation. So generally, consumers, customers across segments, B2B customers as well, are feeling the pinch, and this is reflected in sectoral activity. If you look to the chart on the right-hand side, we are also seeing that all businesses across sectors are seeing much weaker financial conditions. We can see utilization is down. New orders are also substantially down, so this does represent a weaker demand for multinationals. But we're also seeing financial conditions, and this really represents things like cash flow access in Nigeria worsening. And what this means for multinationals is that not only is there weaker demand at the moment for their products and services, but also local partners are facing heightened risk of cash flow difficulties, weaker domestic demand. And so this does mean that sort of providing support for local partners in Nigeria is becoming increasingly important. Well, if you could move on to the next slide, please. Turning to the coronavirus situation in Nigeria and the response by the government, I touched on this a bit earlier, but Nigeria is a very interesting case of the approach by the government to managing the coronavirus pandemic. As I said, it's one of the few countries where the response has not been nationwide, has not been uniform across the country, and this has meant that we've seen a patchwork of restrictions and regulations across the country, which can be quite difficult for multinationals and their local partners to work with and to understand. What we're seeing generally in Nigeria is a gradual easing of restrictions at a state level. The state governments are likely to reintroduce restrictions at short notice, but the direction of travel in Nigeria is towards more opening up, fewer restrictions. This doesn't necessarily mean, however, that interstate travel is going to be easy. There are still restrictions when it comes to transporting products between Lagos and Kano or Abuja, for example. This also doesn't necessarily mean that the pandemic in Nigeria is actually improving. We are seeing an increase in cases. The pandemic seems to be expanding across the country. And this doesn't necessarily bode well for the country in terms of the health outlook, but we are nonetheless expecting a sort of gradual opening up of the economy on an ad hoc basis at a state level. Will, if you could move to the next slide, please. So we're turning to looking at what the impact of the economic slowdown will be on demand growth over the next few quarters or so. So we did see the economy grow in Q1 this year, and this was before the real effects of the oil price crash and the pandemic took effect in Nigeria. But our data for Q2, preliminary data for Q2, shows a slowdown in all the drivers of growth. And this reflects the effects of the lockdown and the slump in oil revenues that will take their toll on government finances. Looking ahead for the rest of the year, we are expecting a sharp contraction in government spending. Overall levels of investment well into Q3 and Q4. Consumer spending is also expected to contract throughout the year. And this means that demand across industries and segments will remain weak well into the end of Q4 this year. We're not expecting anything that looks like a recovery before 2021, but even in 2021, the recovery will be quite weak. We're not expecting a broad-based recovery. We are only expecting something that looks like a broad-based recovery towards 2022. And so this really does point towards a fair amount of demand weakness in Nigeria. If we move on to the next slide, we can see the annualized figures of the trends I've just described. Really, the data that stands out here is a contraction in government spending by almost 10% on an annualized basis in 2020. And this really reflects the sharp deterioration in public finances as a result of the decline in global oil prices, so much weaker demand for companies looking to sell to the public sector. If we move on to the next slide, looking at scenarios for Nigeria. So our base case view for Nigeria is that the economy will contract by 3.3% this year. However, there are substantial downside risks for Nigeria. And under a downside scenario, we would see the economy contract by over 6%. We would see the drivers of a downside scenario being even weaker global oil prices, So that's a global factor, but looking domestically, there are a couple of risks to monitor, one of which is a return to strict foreign currency controls. The central bank has introduced a number of forex reforms recently, but these could be rolled back, and this would make it much harder to access dollars in the country, and this would also be a real disincentive for foreign investors and depress domestic economic activity. Another protectionist measure that is that has a high chance of being introduced is new import bans. The government has already introduced a number of food product import bans, but if these are expanded further, that would have a negative impact on the economy and domestic demand. The reason why this is also important is that under a downside scenario, we would see even sharper contractions in demand in Nigeria, but also it highlights the importance of scenario planning for Nigeria, and also working closely with local partners in the market to plan for a downside scenario in the country. I'll spend a minute or so looking at the other West African markets, starting off with Angola. So very briefly, Angola's economy is expected to fall deeper into recession this year. This is mainly because of the decline in global oil prices. This is the 5th consecutive year of recession, so demand conditions in Angola will remain very weak. Another issue worth looking at is the Kwanza. So we are expecting continued depreciation of the Kwanza in Angola over the coming year or so. This does mean better access to foreign currency, but difficulties planning. Looking to Côte d'Ivoire, it's one of the more resilient markets. We are expecting continued growth this year with the recovery next year. We have particularly favorable demand conditions for consumers, and this will remain for the rest of the year. However, a couple of risks that are worth noting. One relates to government finances linked to oil prices, but also pre-election tensions. There is an election planned in October this year, and there is a risk of violence and unrest at a localized level, although no return to a civil war in our base case. And finally, 1 minute on Ghana. We also are not expecting a recession in Ghana, although it is slightly less resilient than its neighbor Côte d'Ivoire. We are expecting the government to maintain some spending ahead of the election at the end of this year, which will support the economy. But investment projects are likely to be sacrificed, and we are seeing the effect of low global oil prices on government finances well into next year. Domestic demand conditions are also quite tight, especially for businesses. Thank you, Will. So I'll hand it back to you to look at South and East Africa.
Great, thanks so much, Matt. So we're going to do a bit of a deep dive on South Africa and then touch on to the key East African markets as well, if we have time, before moving on to our Q&A session to close the webinar. So this current situation in South Africa, to provide a bit of a snapshot, has been of quite significant. The Statistics Bureau has been issuing a number of business surveys, which is probably the highest frequency source of understanding how businesses are responding to the current climate. As we can see on the chart on the left-hand side here, April, certainly late April, when lockdowns were fully in place, one of the strictest lockdowns in the world, actually. Most companies really saying that they're experiencing below normal turnover. Most companies still say they are experiencing below normal turnover, but a slightly smaller proportion, well over 80% of them. And of course, really every industry affected, construction in particular, because there was effectively no construction activity happening, but trade, which is resale and wholesale trade, mining, really big slowdown there, manufacturing, really reduced capacity allowed to operate in manufacturing as well. So having a really significant impact on economic activity, and this is reflected in our growth forecasts as well, which I'll turn to in a moment. One of the important factors here, I mentioned earlier, South Africa being one of the more important and certainly sizable stimulus programs put in place by an SSA government, equivalent to 10% of GDP, a number of measures put in place to try and help businesses come through the crisis and hopefully out the other side. I have heard, though, from clients that a number of these measures are not being rolled out very swiftly, So some of the soft loans, some of the additional credit that was supposed to be issued to companies has taken quite a long time to come through. So I think overall the impact in terms of helping companies come through the crisis and trying to offset the economic downturn is going to be fairly muted. That said, it's better than nothing, and certainly puts South Africa in a better position than some very high risk markets. This scheme is reflected in some of the budgetary changes that we saw in the finance minister's supplementary budget the other day. One of the big changes we've seen compared to the formal full year budget that was issued in February was the greater spending allocated towards social development, particularly transport payments, so additional social welfare grants, that kind of thing, issued to particularly vulnerable households. That's one of the biggest changes, and of course an increase in healthcare spending too, particularly on areas affected by COVID-19, so containment and mitigation measures around public health to do with COVID-19, which is unsurprising. Healthcare, as you can see from the original budget, was a significant spending priority anyway. But going forward, rather like some of these other SSA markets, we do expect some areas to have to experience cuts into the medium term. Some areas of general budgetary expenditure, the general government bureaucracy, foreign affairs, those kinds of areas probably going to be seeing budget cuts in the next several fiscal years. There's a very significant risk, of course, and what the budget also revealed was the government's very dire debt outlook. Revenue has really continued to fall below expectations. It has done so for several budgets in a row, but now facing a very significant revenue gap, and as a result, the fiscal deficit's really going to climb, and the government is being forced to borrow. So our view at the moment is that the government is unlikely to be able to meet its debt containment plan. The finance minister outlined in that supplementary budget speech. We're hoping to stabilize debt around 87% of GDP and then start to bring it down in sort of later in the 2020s. We think that's probably wishful thinking given the political reality. It's not going to be so easy to do things like contain the public wage bill and so on due to the political environment. So we do expect debt to continue to climb and continue to squeeze some of those areas of general government expenditure. Nevertheless, healthcare, education, and so on likely to remain spending priorities and going to be recipients of large budget allocations in the next several years. In terms of, I suppose, what the government stimulus, but also the wider COVID story means for the South African economy, we of course expect a very deep contraction in economic activity, well into the double digits in Q2. That was when the strictest containment measures were in place. We still expect some kinds of lockdown to be in place in Q3 and even into Q4, and possibly stricter rules applied in certain geographies. I know the Western Cape, for instance, has been very severely hit and quite a concentration of cases, although the cases seem to be accelerating in Gauteng province as well. So we could see localized, much stricter lockdowns in certain places, but generally the direction is towards loosening some of these measures going forward, and that's going to certainly allow some additional economic activity to happen and for the economy to gradually stabilize through 2020, although by no means bounce back. And again, as I mentioned earlier, growth numbers in the range of sort of 2% or so certainly don't represent a recovery. It just represents the fact that we're not contracting even further. The base effects of those deep recessionary conditions in 2020, of course, creating a positive effect on growth in 2021. That said, those structural limitations that are affecting the South African economy for some time are going to continue to be there. through 2022. So very high unemployment. We expect unemployment to really getting to 30%. We expect it to exceed 30% and stay in the low 30s, into the 2022 and beyond. So very high unemployment affecting consumer demand, for instance. The rising debt servicing costs affecting government current expenditure, all of these things, electricity shortages, all of these things affecting the capacity of the economy to grow. And really, we expect growth to sort of average around 2% or so, well into the 2020s. No big takeoff expected anytime soon. In terms of the key outlooks for the operating environment, we do expect inflation to actually come down this year compared to 2019. And that's really due to, on the one hand, the favorable global environment when it comes from the perspective of oil prices. So we've seen a number of fuel price cuts, certainly beneficial for the inflation outlook in South Africa. But really the big driver here and why 2020 is such an unusual year is the considerable slowdown in demand. So that is certainly pressuring inflation too, and we expect that to dampen. On the currency front, the rand, of course, is one of the most volatile of the major emerging market currencies, very highly traded. And certainly when COVID first hit and global markets responded, we saw the rand essentially crash through the floor. We got close to 19 or past 19 rand to the dollar at one point, getting even close to 20 rand to the dollar. Now we start to see a little bit of a turnaround. Emerging markets seen somewhat more favorably recently as a source of yield for international investors. And so we've started to see a bit more strengthening of the rand on the back of that. But going forward into 2021, we'd expect a little bit more strengthening as well. Again, for those reasons, international investors seeking a bit more yield in a context of very, very low interest rates, in many cases zero, in some cases negative interest rates in developed markets. I mentioned important to work with scenarios when planning ahead. And here I'm just presenting our downside and upside scenarios for South Africa. As you can see, under no circumstance do we expect positive economic growth in 2020. The external and domestic environment certainly doesn't allow for that, even in an upside situation where COVID-19 is contained very quickly and big global trading partners return to growth sooner than expected. Even then, we wouldn't expect a big bounce back in terms of growth. Important though to plan for a downside scenario, because actually we could under a downside scenario where COVID extends much further, we see real fiscal instability in the government, a real reversal in terms of that investor sentiment, and a real crash in the rand. That's a situation where we could even see the scale of the recession deepening. That's where we'd have really sizable unemployment and the economy essentially going into crisis mode. This is a very feasible situation, but it's not our base case. But nevertheless, important to plan for it going forward. So in the last few minutes we have, before we go into some of that Q&A, I want to just provide a top-line view on the really key East African markets here. So Kenya, we have revised our forecast down quite considerably, only really around 1% GDP growth this year, which, although still in positive territory, of course, is a huge diversion from the typical trend growth that we've seen in Kenya over the past several years, which has tended to be in the sort of 5, 6, 7% year-on-year growth each year over the past several years. One of the key items to point out here, though, is the slowdown in government spending going into 2021. We'd expect a bit of a spike around the election the following year, but then actually continued fiscal consolidation. And this is really this classic story of the debt build-up and the debt servicing costs beginning to really squeeze government finances. So over time, we'd expect slightly fewer of those big mega infrastructure projects announced, for instance, a little bit more moderation in terms of government spending going forward. That said, on consumer investment side, we'd expect relatively swift recovery into 2021 and beyond, rather like we're seeing in Francophone West Africa. Different story in Ethiopia to some extent. We don't expect necessarily the same scale of bounce back in investment. Part of that has to do with the political risks around the election next year. FDI, although Ethiopia to date has been a favorite for investors, particularly given some of these big infrastructure projects, but also a lot of interest in the potential of the manufacturing sector in that country. Certainly the political risks going to 2021 don't look too favorable from a investor perspective. We'd expect a bit more of a delayed recovery in the investment appetite for Ethiopia. There's also, of course, structural challenges in that market which are going to persist well into 2021, and we don't expect it to bounce back to those 7, 8, 9% GDP numbers that we've seen in previous years. Particularly as we see some damage to the informal sector and the agricultural sector persisting a little bit longer. Now, I know we have about 8 minutes on the line here to cram in a couple of Q&A questions. I know we've covered a vast continent and a lot of issues. So perhaps we can just touch on, I suppose, if there are any key question themes that have come through. Zeynep or Matt, I know you've been following the questions coming through the line here.
Yes, thank you very much, Matt and Will, for the presentation. We have had some questions come through. The first one is around the restrictions, of course, in Nigeria, import restrictions. The question is whether the food import restrictions and the FX restrictions for imports in Nigeria include raw materials. So I guess that one is for you, Matt.
Yes, that's right. So thank you, Zeynep, and thanks, Will, as well for the presentation. It's a great question. It's top of mind. Well, import restrictions, forex access restrictions are top of mind for companies doing business in Nigeria. It's a perennial challenge that companies and local partners face. Now, I should clarify that there are very few blanket bans from a sort of legislative perspective on imports in Nigeria, and the bans really refer to access to foreign currency. So the central bank has instructed commercial banks not to issue foreign currency for the importing of a range of products which mainly focus on agricultural products. Now, the central bank is most focused on processed or refined products that it feels Nigeria should be self-sufficient in, and these include things like rice, milk products, wheat as well. But there may also be difficulties accessing raw materials for certain products if the government and the central bank feel that these should be produced in Nigeria. Now, companies that are looking to import raw materials into Nigeria will find that if they have a local manufacturing presence, or if they can prove that the raw materials are going to be used or are going to be processed into final products at a factory or a food processing facility in Nigeria, then they will be more likely to gain access to foreign currency. And this is because the government is trying to incentivize local manufacturing. I would note, however, there are other issues around forex access and importing products into Nigeria. Many of our clients will tell us that even with the import bans in place, they can still get their products into market as long as they have access to foreign currency somehow. And also there are major challenges around parallel imports into Nigeria. So many products get their way into Nigeria through land borders as well. So it's quite a sort of complicated situation with regard to access to foreign currency in Nigeria.
Okay, thank you very much, Matt. This is a constant challenge for a lot of multinational companies, so thank you for the clarification on that. And we do have another question. This is also, again, very top of mind for all multinational companies, regardless of their industry. And that is, of course, the accelerating trend of e-commerce under COVID-19. So there was a question around how e-commerce could offer solutions to maybe getting around costs or logistical challenges. How can we contextualize the use case of e-commerce or the opportunity in Sub-Saharan Africa? I guess that one's for you, Will.
Yeah, thanks, Zeynep. And this, I suppose, takes place in a context where we know a lot of companies with business in SSA are really reconsidering their route to market structures. I know a lot of vulnerabilities have been revealed as a result of things like border closures, the curfews and so on, really making, I suppose, normal day-to-day business quite difficult, really impacting supply chains. And I suppose one of the areas where companies are looking to innovate perhaps going forward is e-commerce. It's a question we get a lot. And certainly there has been a takeoff in certain geographies. So in South Africa in particular, a huge jump in terms of innovation around e-commerce, utilization of e-commerce platforms. Many of the big grocery chains, but also clothing and other retail outlets really building out their e-commerce offerings quite quickly. And it shows that there's certainly a consumer behavioral shift, which has tended to be behind the curve compared to other regions for some time. But now we actually are seeing a big change in terms of consumer behavior. But that said, it really is quite a South Africa story in many respects. Perhaps pockets of Kenya, Nairobi, perhaps Lagos to some extent, and one or two other sort of major urban centers seeing a bit more e-commerce. But many of the same challenges that have prevented its growth in the past remain. So the real infrastructure difficulties, issues around payments, and of course trust. I know has been a big issue, particularly in Nigeria. But some of the markets where people perhaps have a bit less faith in the payment systems and in their goods actually being delivered at the end of the day, certainly constraining some consumer behavior from moving forward onto online platforms. So that's, I would sort of put a note of caution there. We're not expecting an e-commerce boom across the region, but certainly in the more developed hubs, perhaps a little bit more as consumers' behavioral trends sort of shift perhaps a bit more online into the future. But certainly, primarily still a non-digital retail environment through most of SSA.
Yeah, that is very important to, I guess, set a realistic assumptions around e-commerce in Sub-Saharan Africa. And we have one more question, just a final one on the influence and kind of the drive for foreign investment from basically these host countries post-COVID. Basically, for example, is China going to be influencing more Sub-Saharan Africa or less? Do we believe after this kind of COVID crisis? What is the foreign investment interest into Sub-Saharan Africa and China's influence looking into the future?
Yeah, really, really big question and an important one. I know a lot of governments are going to be eager to attract back that FDI. We, expect FDI really to bottom out this year. No appetite from big companies really to be making big bets at all through 2020. But going forward, we would expect investment to gradually return. We know that foreign investors do want to see a return on the resources that they allocate, and Sub-Saharan African markets, as we've outlined, are expected to grow going forward into 2021 and into the 2020s. So that does create opportunities, and so we would expect some investment to return, but perhaps not in the sort of gung-ho fashion we might have seen in the past. Talking to clients, senior decision makers in big multinationals, we certainly sense that there's very little appetite for big risky bets going forward. Any investments, whether FDI investments or investments in putting personnel on the ground, anything like that, we'd expect to be very carefully calibrated to make sure that they can get that return on investment that they need in order to make the case, I suppose, for SSA going forward. So a much more cautious approach to investment, but we would expect it to be there, and particularly on those big important markets like South Africa, like Nigeria. Even with the poor growth outlook, those markets are too big to ignore, and really the trend that we've been hearing from clients has been that they're doubling down on those markets, if anything. And if they are allocating resources, it tends to be on those markets where they can get that scale in terms of sales and revenues and looking forward perhaps profits at the end of the day as well.
Perfect.
I understand we're at the top of the hour here.
Yes, we are.
Yeah, maybe I'll hand over to you, Zainab, if you can wrap up.
Of course. Well, thank you very much, Matt and Will, for all the content and for all of our attendees. We will be sharing the presentation deck that you have seen and also the recording of the webinar tomorrow morning. You will receive it in your inbox. So thank you everyone for attending our webinar, and hope to see you in the future ones that are coming up from the Frontier View webinar series. Have a good rest of your day.